Hello traders, in this video I thought we would review a very exciting trading year. 2020 was crazy and we had a fantastic year, but I don't want you to take my word for it. I want to prove it to you. I want to go back and show you the videos that I posted in YouTube. I want to go back and take a look at comments that I posted from my blog. I want to go back and take a look at our actual trades that we did throughout the course of the year. And you know that that's how I like to operate. When I post my YouTube videos, I'm not showing you trades that we did. I'm showing you trades that are set up right now for really good trading that you can take advantage of so that over the course of time, you gain the confidence that you need to sign up and try Option Stalker. So let's go back and see what the year looked like. This was the largest market decline that we've had since the Great Depression, a 36% drop in 1 month. For most traders, they're looking at this beautiful, strong rally, and this is very, very important in terms of the context of how we traded the entire year. We are in an 11-year bull market. So that means that the upward momentum is going to be very, very hard to turn around. But the coronavirus certainly was able to do that. If you were not paying attention in here at the beginning of the year, you were going to lose a ton of money if you're a trader because you're leveraged. You're highly leveraged. That's why it's critical for us to always be able to forecast the market accurately. Market first, market first, market first. That holds true on a monthly chart like this, on a weekly chart, on a daily chart, on a 5-minute chart. Market first. So, in terms of a monthly chart on the S&P 500, it's very rare to see one bar stand out like this. And when it does, you know that you've had a volatile year. Now we can see that the S&P 500 did finish higher on the year, but not after a lot of pain, and it's taken us the entire year to grind back. Right now the S&P 500 is up about 15% year to date. The NASDAQ, however, is up about 42%. This is starting to remind me a little bit of the tech bubble that we saw in the year 2000. And you can also see how we've got this upward sloping trend line here that's been broken to the upside on a monthly basis. Little bit problematic, but we'll get to that at the end of the video because I will also tell you what I think is going to happen in the first quarter of 2021. So, on the first trading day of the year, I thought this was interesting. I went back to YouTube and I grabbed one of my videos. 50% day trading winner right out of the gate. Here's how to day trade. As we're watching this video, it's important for you to know that I do a lot of swing trading. I prefer to sell out of the money bullish put spreads most of the time. Yes, I will buy calls as well when I swing trade under certain market conditions. But in addition to swing trading, I am a very, very active day trader. So if I see a market move setting up, I'm going to day trade the heck out of it. Now, on the short side, I'm relatively passive unless I see some really nice technical breakdowns. Then I will be day trading from the short side all day long. But I won't want to swing trade it if the market is in a strong upward trend. In this instance, first trading day of the year, the market gaps higher, and the opening from that gap higher fails almost instantly. About 35 minutes into trading, we also had a big 10p bearish cross to start the new year. That was an excellent shorting opportunity for us. That gap filled in. But I just thought it would be interesting to show you what the first trading day of the year looked like. Boom! Right out of the gate, we started nailing trades. Now you can see my market comments, and I took these off of my blog, and these are all timestamps so that you can see the date and the time that these posts were made. Market bid is strong. Use this option strategy into earnings season. Well, what we've been doing is we've been selling out of the money bullish put spreads, and this was the start of the year. Beautiful, nice, easy, gradual little rally here. Beautiful for selling out of the money bullish put spreads. Lots of tight little candles. That's signaling that the trading ranges are fairly compressed. The trend is fairly strong. And that had actually been a strategy that we've been using since September of 2019. We had a full head of steam heading into 2020. We had had week after week after week of winners, and we just continued to use that same strategy, and we were going to keep using it until conditions changed. So now as we start to progress, you can see right here in February, market is strong. It's time to buy, use this option strategy. We're continuing to sell out of the money bullish put spreads in February, but notice the date. This is February 5th. By February 13th, coronavirus back in the news. Market direction could be determined early. Watch for this pattern. I'm already starting to see signs that this market rally could be on borrowed time, mainly because of the news coming out of China. During the Chinese New Year, their biggest celebration of the year, the entire country was shut down. And I kept reading more and more stories about how dramatic these measures were. When you take the United States, for instance, and you shut everything down, I mean absolutely shut it down, imagine the economic impact that you're going to have across the retail sector, hotels, restaurants. I could see this coming. This was not going to end well. So by the middle of February, we'd already had one little market dip that was coronavirus related. I was starting to really peel back on my bullish put spreads. We were doing fewer and fewer bullish put spreads. And we had this little market dip right in here, which I thought, ooh, this could be it. This could be the one that cracks down. Now, we had option implied volatilities at historic lows. Bullish sentiment was off the charts. No one was worried about the coronavirus. We had interest rates near 0%. So money really had nowhere else to go but in the stock market. When you get that type of complacency, it's the perfect storm for a big market decline. But when the market found support here, we started to sell a few more bullish put spreads. This was still in January and into the first couple of weeks of February. Swing trading options, credit spreads, 6 bullish put spreads, 5 bearish spreads. This was on the 19th of February. 19th of February, we had just made a new all-time market high. You can see it right here in this screenshot. I hadn't done any bearish spreads in probably a year, more than a year. Why all of a sudden am I starting to add bearish spreads into the mix? That's because I could see what was coming. Now, this was on 219, and we didn't get filled on any of the bearish spreads that we were trying to do, and we only got filled on one bullish spread that we were trying to do Thursday morning. And I remember this clear as a bell. It was on the 20th of February. The market opened higher and it immediately sold off. And I thought that was a really hard round of selling. We've got some problems coming up. And you can see here that I posted, watch out for this pattern. And here I'm talking about this Disney trade that we put on. Out of the 11 trades that I had highlighted, 6 bullish put spreads, 5 bearish call spreads. Out of all of those trades, Thursday, there was only one trade that we were able to get in on, and that was a Disney bullish put spread. And you can see it right here. As soon as we got in, I sent an alert out and I said, buy this back. Buy it back immediately. I don't care what you have to pay for it, just buy it back. Well, we were able to buy it back. I think we put it on for a 21-cent credit. I think we bought it back for about 40 cents. So we lost money on that particular trade, but this put us in a complete cash position. Now, we did still have some bullish put spreads on, but they were so far out of the money and time premium had been sucked out of them to where they were trading for pennies. So our risk at this stage was minimal, and that was a good thing because I could see that there was a storm coming. Now, on February 23rd, this was Sunday evening, I started to evaluate what was going on in the market. The action Thursday, the action Friday really prompted me to do this video, and this is actually where my YouTube channel blew up. I had so many hits on this particular video. Buy put options Monday, market drop coming. And again, this is all timestamped, so you can go back and verify. This is on February 23rd. That is February 23rd. The market opened and it was very, very weak. This is the price action that had me concerned. That was Thursday's price action, that was Friday's price action. Not at all what we were expecting. You could see the signs of selling. And then over the weekend, as I'm looking at all of this upward sloping trend line breached, I thought, you know what? This is not going to end well. I turned on my computer and saw the futures down. That's when I knew this was going to be really, really nasty. And no one was prepared for it. When you have option applied volatilities at historic lows, that tells me that asset managers are not buying protective puts. That's how the option implied volatilities get to be so cheap. When they're not protected and the market has a big fall, all of a sudden they're scrambling to add protection. They're either shorting futures, they're buying options. But in any event, you can see how that Sunday night video, boy, was that timely. That was right off the all-time high. Again, we have very few positions on. Right here on Friday, we had a number of bullish put spreads expire. I was very, very happy that that had happened. And we still had about a week's worth of bullish put spreads on, I think about 3 or 4 positions. The market came in that week, it bounced a little bit. Those options expired. Again, a little intense during those periods, but we were in the right stocks, which is the second part of the equation. Get the market right, find the best stocks. If you're in the best stocks, that's also going to provide you with a lot of cushion. That's exactly what we do. We were selling those bullish put spreads below technical support. Those technical support levels had held. We got a little bit of a market reprieve. They expired worthless before the next leg of selling. So at this point, we are 100% in cash. We are watching from the sidelines. That was the plan. So the market starts to come in really, really hard. Biggest market decline that we've seen since the Great Depression, as I mentioned earlier, a 36% market decline in a month. It was gut-wrenching. You can remember it. We all went through it. Just blank stares on people's faces. What is this coronavirus? How in the heck are we going to get through this when the whole economy is shut down? Could we possibly die from this? Is it that bad? A lot of unknowns. So panic selling hits the streets. We're in cash. What are we doing? We're looking for opportunity. We're taking advantage of opportunities. Selling naked puts in a market crash for stock picks. This is on March 18th. And you can see out of the corner here, oh my God, the market is in a free fall. Are you crazy? You're selling puts and the market is crashing like this? What's wrong with you? Well, it's opportunity. It's a beautiful opportunity. It's the opportunity of a lifetime, which incidentally, in that post that I had highlighted earlier, where you could actually see my blog comments about buying back the Disney spread, I had also mentioned we need to be buying some VIX. Well, this is what option implied volatilities were before the market crash. You can see how they're at historic lows. No one is expecting anything to happen here. In fact, the prevailing mentality was, it's a virus, it's a virus. We've had viruses before. It's going to come, it's going to go. What am I going to do? Go to cash? I won't make any money there. I won't go into bonds. They don't even keep up with inflation, so I'm generating negative real returns. I'm just going to stick with stocks. That's where my money needs to be to generate any kind of reasonable return. So yes, virus, we know about it. I'm just going to ride this out. How bad could it possibly be? Now, if you're a very long-term investor, you can see the S&P 500 recovered and it's up 15% this year. And that mentality certainly is fine and it can work. But there were some gut-wrenching moments for long-term buy and hold investors. If you're a trader, you don't have that kind of luxury. You are leveraged. And when you are leveraged, the type of drop that we saw in March will absolutely wipe you out if you're not paying attention. Well, we were paying attention. And you could see how that VIX trade ended up being very nice. The VIX went from, I believe, about 15, and I think it got up to about 80. You could see how that option implied volatility exploded. Well, that's what I highlighted in this video. We're going to be taking advantage of that option implied volatility and that explosion. And it may be a little bit difficult for you to see, but on March 13th, here's what we're doing. Sell the Facebook sell the Facebook April puts. We're selling the 100 puts for $2. Twitter, Cisco, Google. This is one of my favorite trades. Sell the April 17 650 puts at $6. Well, let's take a look at those charts. So we have the market pulling back. We have Google pulling back. Now, this is a time when I had to lift up the hood, get into some fundamental analysis. And what I was looking at in particular were companies that had extremely strong balance sheets. Companies that would benefit from the coronavirus. Well, Google, if people are stuck at home, they're going to be watching more YouTube. Google should actually benefit from this. They're going to be doing more searches because they're at home. Google had so much cash on hand, I like to subtract out the total liabilities from current liabilities, and that tells me how much cash the company has, and then I divide that by the shares outstanding. The point here is that I did a lot of fundamental research on these companies. I knew which companies I felt very, very comfortable owning. No matter what happened to the market, this was going to be a strong company and it would be able to hold its own. So down here, when the market is coming in hard, Google was at about $1,400, excuse me, $1,400. So think about this. $1,400 on Google. We are selling the $650 puts for $6. The stock would have to lose 50% of its value in the course of 2 weeks for this trade to go sour. Never came anywhere close. Now, that was a 5% winner. Many of you who are option traders could be thinking, what's a 5% winner? Seriously, you're going to be touting a 5% winner? That's crazy. Well, first of all, it's 5% in about 7 trading days. I think it was a week and 2 days that these trades spanned. So 5% in that short amount of time is a really nice return. The other thing is that the market was in an absolute free fall at that time. So you don't start out by going gangbusters in an environment like that. You dip your toe in the water. You find the safest trades that you can possibly do. Google was a fantastic play for us. Here's another great one. You can see Facebook was down to $144. We sold the $100 puts. Okay, so Facebook would have to lose 33% of its value in about 7 trading days for this trade to go sour. We sold those for $2. That was a 10% winner in 10 days, 7 trading days. Those are the types of trades that we were taking in a market free fall, which incidentally, if you looked at every one of those stocks that we were selling out of the money bullish put spreads on and selling naked puts on during this huge market decline, we were focused on the best stocks. All of those stocks led the market rally. As I'd mentioned to you earlier, NASDAQ is up 46% this year. Those are the first stocks to make monster moves back. Why? Because they had a ton of cash on hand, because they didn't have to have physical employees working. They could work remotely and still get their job done, and because people were using social media. Very efficient, lots of cash, perfect setup. Well, those are exactly the stocks that money managers plowed into. Get the market right, find the best stocks. Then the option strategy is very easy. You just evaluate market conditions, and that'll determine how aggressive you can get with these trades. Well, at this stage, when the market's falling apart, biggest decline since the Great Depression, option implied volatilities off the charts expensive, you're not going to be out there buying calls. You're going to be starting out with a strategy like this. So you can see in the following week, this is the staged order entry screen that I post, and I took a lot of these screenshots off of YouTube. So I went back and I watched the weekly swing trading videos. Again, mind you, on the way down as the market's coming in, no, I did not buy any long-term puts. Yes, I was long VIX and there were some other intraday shorts, a lot of intraday shorts, in fact. We're day trading the short side like crazy in March. But I did not want to take a short overnight position. It was too dang scary to me because we're in an 11-year bull market rally. So, certainly on a swing basis, when I've got a lot of members who can't watch the market intraday, when you get those snapback rallies, they are violent and they can destroy an account in a day. So, no, you do not want to be buying puts and holding them overnight if you're a swing trader who can't watch the market. So, that's why our best course of action was to continue to trade from the long side, have the market tailwind at our back, and just wait for these opportunities to set up. Yelp. SWKS, SQ, ITT, CRUS. These were all excellent plays. And now, this is on March 24th, now we're starting to hammer, still selling out of the money naked puts, but now we're starting to pound this strategy. And these options are going to expire in a very short amount of time. So we're going to take advantage of that, and then we're going to start switching over when market conditions improve. Now you can see this is a week later. Look at all these positions that we're trying to put on. Now, we didn't get filled on all of them, but we got filled on an awful lot of them. And I just skipped forward instead of showing you week after week of these staged order entry screens. I wanted to go in and show you these are all the spreads, and I was posting trades during the week on Wednesday nights. I was also posting trades on Sunday nights. Look at all the spreads, and you'll notice, aha, now we're starting to shift in here. That is a bullish put spread on April 12th. Now we're starting to get a little bit more aggressive, and instead of just selling naked out of the money puts, now we're starting to get a little bit closer to the money and have more of a bullish feel to those spreads. And now we're starting to use more leverage. When you sell naked puts, you've got to put up a lot more margin than you do when you do spreads. So because you're putting up more margin, you're not as leveraged. But as soon as you start selling out of the money bullish put spreads, now all of a sudden you're more highly leveraged. And on each one of these bullish put spreads that I do, I like to generate a 25% return. So every time you see a bullish put spread that we're in, you should associate that with a 25% winner. So yes, by the middle of April, we are boom, 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 boom. And we're not waiting around and we're not waiting for stocks to come into our price. We're nailing them right here, right now. And I had gone back and taken a look at some of the videos. I was posting them early on Tuesday nights because I wanted to make sure that we were capturing the market as it was bottoming and able to sell these spreads as soon as possible because I didn't feel the prices would be there very long. At very least, option implied volatilities were going to contract, and that was going to make it more difficult for us to get these spreads off. That Facebook and that Google trade that I showed you, they weren't there, but for an instant, an option implied volatilities started to come in almost immediately. So in April, we're still going gangbusters. And you can see right through April, now Facebook, Netflix, VLO, Google, Starbucks, ROST, these are all PayPal. A lot of tech names in here. These are all the stocks that we're trying to take positions in. Now we're into May, and we're continuing to use that strategy. Again, lots of bullish put spreads. You'll see a lot of familiar names in here. Folks, we didn't have a loser from that Disney trade that I told you about. That was our one loser for the entire 2020 trading year from January until I believe August. And we had done dozens and dozens and dozens of trades. Every week I come out with at least 4 new trades. Well, times 50 weeks, that's 200 trades. That's at least 200 trades. I'm thinking probably closer to 250 trades. Now, we didn't get all of those done, but I'll bet you for sure we at least got 100 of them done. And we only had a couple of losers. I think we had maybe 4 losers all year. That's the type of winning percentage that you need to have when you're swing trading. Selling out of the money bullish put spreads, you see me posting a lot of videos on that strategy. If you're a novice trader, you should learn that strategy. Vertical option spreads, we want to be selling out of the money bullish put spreads. It's very, very consistent. This is a great way for you to start trading. There's lots of room for error in these trades because we have probability on our side. We also have time decay working in our favor. And what the heck, if you're making a 25% return on a trade that lasts 3 weeks, that's a really good return. This is a strategy that you should look into. So you can see as we continue into May, we're still selling. The yellow means that we weren't able to get into the trade. The white means we're in the trade. The green means those were successful trades. But the point here is that we're continuing to use this strategy as the market is bottoming out. It's starting to come off the bottom. We're finding stocks that have relative strength and heavy volume, and we're selling these out of the money bullish put spreads below technical support. That strategy worked extremely well. So there's your market decline right in there. We bottom out about the middle of March. This is when we were selling those out of the money naked puts right through here and even into here. And now that we've got a little bit of a market bounce forming, you can see that this is a higher low, double bottom. Now we're starting to really step it up because I like what I see. I'm pretty confident that this low is going to hold. Now we start shifting into selling out of the money bullish put spreads, a much more leveraged strategy. Option implied volatility is still very high, so we're being properly rewarded. Now the market continues to rally, and here we go. We've been selling out of the money bullish put spreads the whole way right up until here. Now, the market to me feels like it's getting overextended. We have this upward sloping trend line right here that's been violated to the upside. That is usually a warning sign. As I started to see this last bit of rally right in here, I'm starting to get pretty nervous about it, particularly because I'm watching the volume decline. That's not a good sign. When you have a very, very tight trading pattern and a breakout through the upper end of a channel on light volume, that is a time to be very, very cautious. So this is in June. I start getting a little bit concerned about this, so we're not as aggressive selling out of the money bullish put spreads. And you can see here, this is on June 3rd. These are my comments from my blog. Incidentally, my blog is free, my Twitter feed is free. I offer so much free information on a daily basis that I hope that some of you will take time and post your comments at the bottom of this YouTube video. Let me know how you did. Please let me know how my research helped you navigate this trading year. But in any event, passively play the market rally using this option strategy, selling out of the money bullish put spreads. Prices are extended. This was on the 3rd of June. So let's go back to this chart. The 3rd of June is right here. We haven't even broken out. I'm already sensing that prices are getting really high. So we've trimmed back what we're doing in here, get a breakout here, and now all of a sudden, yes, this is a pitfall. So if you are oblivious to the market and you're continuing to mechanically just sell out of the money bullish put spreads, sell out of the money bullish put spreads, when option implied volatilities start to contract as they had from here to here, now all of a sudden you're having to go closer to the money, you're taking in less of a credit, and you're more exposed to a market move. And again, we are leveraged, so this really matters to us. When you get a market drop like this, all of a sudden your option spreads are in the money. And now you're having to manage losing positions, which is very, very hard to do, very emotional thing to do. You're preoccupied with managing losing positions, and you are not focused on opportunities that this dip might present. So we were able to navigate this without a problem, and we're selling these option spreads inside of a 3-week window so that we have time decay constantly working in our favor, and as these spreads expire, we're able to evaluate market conditions. Well, we've got spreads expiring all in here, and I'm trying to put some new spreads on, but I'm finding it more and more difficult to do because the market is taking off on us and we're not filled. Okay, that's fine. We're almost in a cash position. We're going to wait for the market dip, and then we get one, and we'll be back in business. So you can see here, we go into July. This is July 1st. Market rally in July. Possible trouble in August. Here's why. Now, these are my comments on July 1st. These are not my comments at the end of August. I'm already telling everyone, here's what I see happening. But market will rally in July. So here's the overextension that we had. So again, we're in cash at this point largely. We have some bullish put spreads on. We're in the right stocks. Time decay working its magic. We're not putting a lot of new trades on. We get this market pullback. The spreads expire. Okay, we've got a little bit of a problem. How much lower are we going to go? Market bounces, retest. We have a double bottom, higher low. And this happens to coincide with the July time frame. This is July 1st. And now I see a double bottom, higher low, downward sloping trend line that's been breached to the upside. This is a good opportunity for us to get back on track and to sell out of the money bullish put spreads. That's exactly what we did last summer. And you can see these are our spreads. We're not sitting back. We're not watching. You can see we've been trying to get these bullish put spreads off right in here. We weren't able to, but we were aggressively trying to get them done in the middle of June, and then we keep ramping up. You can see all these new trades that we're trying to enter. We were not sitting back on these trades, and there were a couple of winners that expired. We were aggressively trying to sell out of the money bullish put spreads. Here we're getting well into July. You can see some of the trades that we had put on. And here we've got a screenshot of another loser that we had, and this was on August 26th. So from the Disney trade that we had in February, that was our first loser of the trade on February 19th. Up until August 26th, we did not have a losing trade. Microsoft was one of our losers. We had to buy that spread back for a loss. And this AZN trade we were able to leg out of successfully. That ended up being a winning trade, but we were able to scratch it. But we were starting to get more passive, and that's the takeaway here. As you can see, by the end of August, I'm getting very, very nervous. So I do not want to put a lot of spreads on. And that's what you have to do as a trader is you have got to evaluate market conditions because it governs what you're doing. It governs how aggressive you are. And there are times when you have to throttle back your activity because the market is in a low probability trading environment. That is one of the biggest problems that I see traders make is they don't know how to throttle back their activity. They also don't know when it's time to gun it. When you've got an opportunity that sets up where it's all systems go, swing for the fence. And you do get those opportunities a few times a year. Not often, but a few times a year. And I have no problem really ramping up and getting super aggressive when I see those opportunities. So this is a technical warning sign. Market drop coming soon. Be careful with longs. This was on the 1st of September. Okay, well, here's the 1st of September. Here's when I posted those market comments before the open. We have a nice upward sloping channel here. Everything looks beautiful. Market has almost completely recovered. How much better could it get? Well, this is a buying climax, and I could see the trouble ahead. Bullish sentiment, riding the high end of the Bollinger Bands, option implied volatilities, all of the types of things that I look for that go into my market analysis were starting to show me that there were some problems. Well, we have been throttling back on all of our bullish put spreads right in here to the point to where we've got next to no exposure during this market drop. And this was a pretty nasty one because we fell from 360 down to 320. That is a 400 point S&P 500 decline. And that's another instance where if you're highly leveraged, selling out of the money bullish put spreads and you're not in the right stocks, you're going to get creamed. This is probably going to wipe you out if you're still going full tilt. No problem. We were in cash, waiting for that dip. And then you can see here, September 30th, we're still trying to get into some positions, but we have hardly any positions on. Netflix, Walmart, Abbott, NIO, these are some of the stocks that we were in. And I'm sorry that this screenshot did not come out very well here, but you can see now we're into November, the beginning of November. We're starting to ramp up. This was after the election, but heading into the election, we didn't know how the election was going to play out. We had lots of possible scenarios that could play out with this. The worst being that we would have a long, drawn out process where there was not a clear, defined winner. Some people can argue that we still have that going on right now, but as far as the market was concerned, there was a clear winner. The market started to rally after the election, and now it's been gradually drifting higher. Well, as soon as the election was done, I could see the bid return. Now it's time. We have clarity. It's time to aggressively get back in and start selling some out of the money bullish put spreads. And you can see some of the names here: Qualcomm, SPCE, Apple, HLT, Candy, WKHS, BABA, BA, Cisco, ZM. These are all really good performers. And now on 11/6, so a few days after the election, buy stocks now. Here are the stocks that I like today. So we've shifted now that we have clarity after the election, and we're right back on track getting our bullish put spreads off. And you can see this is the downward sloping trend line that we had. This is the second dip that we had heading into the election. On average, the market has dropped 6% before the election, and it's rallied 6% after the election. So I was fairly confident that once the results were in, we had this nice bounce off the low. The market was back in go mode. Now this actually takes us right into year end. You can see how we have an upward sloping channel. Very nice environment for us to sell out of the money bullish put spreads. At this stage, option implied volatilities have been coming in. So it's very, very important for us to pick the best stocks because we're having to go close to the money. And because we're so close to the money at this stage, the trades take on more of a bullish directional bias than having a way out of the money bullish put spread that's more neutral. So as the market rallies, you're forced to come in a little bit closer. And then now we have year end. Right now, we have very little risk exposure, but you can see all the spreads that we've had on recently, lots and lots of winners in there. And this is on December 4th, earlier this month. Look for a gradual market rally into year end. Use this option strategy now. As you're watching these videos, you can go back, you can look at some of my other comments, but they'll all be consistent with this. This is what our staged order entry screen looks like right now. We have a ZS trade that expired last week, December 24th. We had an RKT spread that expired last week, December 24th. Now, I never do this, but I did it today. Here's the spread that's going to be expiring today. This is Amazon. I don't count my chickens before they hatch. We are short an Amazon 3065 put, and we're long the 3060 puts, and we did that for a $1 credit. That stock is about $220 out of the money with a day left to go. I think we're going to be in great shape on Amazon. But the point is, we are starting 2021 with a clean slate. We do not have any positions on. And what I'm going to be doing is I've set up a $10,000 account. I'm going to be using my Ameritrade account. I don't have any special commission deals or anything. This is just plain vanilla retail, standard rate. I want to show you how a $10,000 account will fare in 2021. So this will be actual trading. Now, I can write naked puts in the account, but I might have to be a little bit more cautious there because of margin requirements. But I primarily do bullish put spreads. Anyway, I'm going to be allocating $1,000 or 10% per trade. As the account grows, I'm going to keep using 10%. So I'll continue to compound it. If the account goes from $10,000 to $15,000 at the middle of the year, I'm going to be using $1,500 per trade. So yes, it will be compounded, but we'll see how well that account can do. And that'll allow you to gauge the success rate that we have. But we've had just an unbelievable year. The day trades, my gosh, that we are finding on a daily basis, absolutely incredible. Well, where do we go from here? What could possibly happen? So what I thought I'd do is I would construct a couple of scenarios that I see playing out in 2021. Now you can see we've got this upward sloping channel right here. This is a gradual upward sloping channel, fairly tight price action. Typically the way that these play out is that you will get more and more buying. And this is just a 1 month shot. I just pasted this in, but this is the type of pattern that ultimately it would end with. Is at some point, this upward sloping channel, you get more and more aggressive buyers who come in, and you break the upper band of this channel. And that's when you're set up to have a pretty nasty backside and a pretty nasty correction. We currently have lots of bullish sentiment. It is off the charts bullish right now. Seasonal strength is working in our favor. You've got a stimulus bill to the tune of $900 billion, and they're talking about another $500 billion in stimulus. Folks, this is not chump change. We had a $6 trillion. It's hard for me to even say that number. We had a $6 trillion stimulus plan this year. This is a 1.4 trillion dollar stimulus plan. Back in the financial crisis of 2008, 2009, unprecedented stimulus program. That was less than $1 trillion. Here we are, a mere 10 years later, we're talking about a 7.5 times multiple on that. The takeaway is that the Fed has been in there supporting the economy for the last 40 years, and we're to the point now to where every little sniffle requires greater and greater action on the part of the Fed until you're painted into the corner and you have 0% interest rates. So from this point on, whatever happens economically, the Fed is toothless. Doesn't matter. They can't do anything. They have no other power. Yes, they could do quantitative easing and all these other types of money printing exercises, but in terms of their influence on interest rates, when you're at zero, you're at zero. You can go negative, and they have in Europe, but how much further negative are you going to go? That's going to be a problem for us in the course of the next say 5 years. When we have these economic cycles, these downturns, they're actually going to have to play out instead of having the Fed prop everything up. A lot of easy money out there. And with interest rates at 0% and with bond yields generating negative real returns, meaning they don't even keep pace with inflation, there's only one thing to do with your money, and that's to be in stocks. So there is a general underlying bid to the market. You also have corporations that are issuing very, very cheap debt. What are they doing with that debt? Are they taking and using the proceeds from those bond sales to increase plant and equipment? In some cases, in most cases, they are buying back their shares. And that's also providing a nice bid to the market. That will continue until there's a financial crisis. Uh-oh, I said it. Yes, a financial crisis. Well, when? How will we know? Well, we'll know. I'll know when it starts rearing its head. I don't see anything imminent now. I don't see anything for 2021, but our national debt is at $30 trillion. If you can imagine that our annual tax receipts are about $1.5 trillion a year, a 1% increase in interest rates on $30 trillion worth of debt, that's $300 billion. If interest rates went up 3%, you're talking almost $1 trillion that we would have to spend additionally to service our national debt. That eats up almost all the tax revenues. This is not a good scenario long term. Again, I'm not worried about it short term. My trading horizon, I try and see the market inside of a 1 month window. That's my crystal ball. I operate very, very well inside of that window. So I don't need to be concerned from a trading standpoint what's going to be happening 2 years, 3 years, 5 years from now. I just trade what's in front of me right now. So for some of you, if you're looking and you're a longer term investor, I still think my daily market comments in Twitter would be of great help to you. Certainly, if you would have been reading them in February, you would have known that there was a real storm brewing. So, one scenario, we've got valuations right now at a forward PE, at a current PE on the S&P 500 of 40. That is extraordinarily high. That means that great news, fantastic news, in fact, perfection is priced into the market. There's no wiggle room here. So there are two ways that this market rally can be resolved. Stocks need time to grow into their current valuations. Profits need time to catch up. Even in Q1, every expert that I've listened to has said that the coronavirus vaccination is going to take a long time. It'll be well into Q2 before it actually starts to have an impact, that enough of the population has been vaccinated to where we start to see the spread rates go down. Well, that means that we've still got a quarter of very soft earnings, and it's going to take even longer for companies to grow into their current valuations. So there are two ways that you can resolve that. One is that you get a market blow off and a market drop. This would be a buying climax. What could be this buying climax? I don't know. Could it be the Republicans retaining control of the Senate? That happens next week when we come back and trade. Certainly, that with a $2,000 per person check that would be cut, that $500 billion stimulus plan that I talked about, that could certainly excite investors starting off the new year. So if we get this type of blow off rally, and then all of a sudden on the backside, it's like, gosh, valuations are so stretched right now, I'm going to start taking some profits. As soon as that happens, bullish speculators who have been buying in here, they get flushed out. That selling pressure starts to feed on itself and the market comes in. So that would be one scenario. And then what happens? Well, the market waffles around, it finds support, and then lo and behold, the next thing you know, we're sometime in May next year, June next year, and the economy is starting to recover, profits are starting to recover, and then now the market is able to work its way back up to this current price point. So that's one way that the market could behave in Q1 of 2021. So we'll certainly be watching. This will be a key to watch right here. Some type of blow off top. Here's another way that it can be resolved. The market just starts to flatline and it goes sideways. Doesn't do much of anything. It's able to tread water. This upward sloping channel eventually starts to move more horizontally, and we're trapped within a trading range. Again, time. Time is what the market needs. Profits need to catch up to current valuations. Time is the key critical component. Now, the one thing that I am going to say definitively about 2021 that's going to be different than 2020 is that from a day trading standpoint, I think some of the opportunities that we had, President Trump was great for trading. He was fantastic for day trading. There were so many cross currents and news events. I had to subscribe to his Twitter feed to make sure that I was always apprised of what was going on. It could have been, you know, here's my red button when he was talking to Kim Jong Un, or it could have been the tariff negotiations with China. The market would hang on every single word. So there was lots of great intraday market volatility. Coronavirus added a lot of volatility to the market last year as well. I see that intraday volatility really starting to come in 2021. And I believe that we'll have to focus a little bit more on swing trading or some very short term overnight swing trades, because when you get into that market environment, most of your money is going to be made in that overnight move. So if you find a really strong stock that finishes on its high of the day, you're probably going to want to carry some of that position overnight. Market opens flat, stock opens higher, you take your profits on the open the next day. When the intraday volatility collapses, it gets very, very difficult to make money day trading. So that is one thing that I see playing out in Q1 of 2021 that we'll have to watch for. As far as overall market conditions, I feel that as long as we do not have a blow off rally like I showed you earlier, as long as we do not have this, then we'll be okay selling out of the money bullish put spreads. But as soon as I see this, I'm going to err on the side of caution. I'm going to let our current bullish put spreads expire, and then we will be looking to go into cash, and then we will be actually looking to short intraday and take some day trading shorts as well. So that's how I see 2021 playing out. We've got opposing market forces in play right now. We have extremely high valuations. We have a very persistent coronavirus. We have what will probably be a very slow, gradual economic recovery. And we've got nowhere better to go with your money than in stocks, because bond yields are not keeping pace with inflation. So those two forces are going to constantly be in check. As far as any kind of long-term credit concerns, yeah, the concerns are out there, but I don't see anything right now that tells me, there aren't any red flags that tell me that we are in a currency crisis, or a financial crisis, I should say. And those signs will start popping up before anything actually happens. On a very long-term basis, the only way that the market can be in a sustained decline, and I am talking a long-term bearish market, is if there are credit concerns. So credit is the one thing that you need to watch. If there are no credit concerns, every market pullback will eventually be a fantastic buying opportunity. So thank you so much for watching. That's the year in review. Unbelievable trading year for us. We are going to pick up right where we left off. If you've benefited from all these videos and from my market comments, please post a comment in the video below. I'd love to hear from you. And I'd also like to congratulate many of you. I've had a ton of members come on board this year, and it's great to see people posting in the chat room, and their questions ultimately start becoming new trade ideas as the light goes off. So I've seen a lot of members who came in and who are really trying to figure out their trading and trying to figure out how to get a handle on all of this. You've come in, you've learned the system, You've learned how to take all the different searches. You've learned how to identify the price patterns that we need. And now you're making money trading. So I'd like to congratulate you. Let's all look forward to a great 2021. Happy New Year. Thank you for watching this YouTube video. I'm Pete Stolzers, and I'm going to keep the trade ideas coming along with lots of education. So make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.